Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that don't make any sense. Tonight, we're having a special edition, my energy sector outlook with a focus on crude oil. I know I've never done one of these before, so I've been really excited and looking forward to sharing with you my thoughts on what I think is going to happen in the energy sector in the next coming quarters. Now, for those of you who are regular watchers, we'll get back to our regularly scheduled programming on Wednesday, since the markets are closed today for Martin Luther King. So let's start out with the positioning of what's going on in the oil market. And we're going to start out by looking at Hedgeopia and their commitment to traders report, which he runs every week, and he shows a speculative positioning. So here we are looking at the net longs in West Texas Intermediate, and we see that speculators are very long, not at their all-time level, but very close to their all-time record long speculative positioning. Now, this is the first time you've seen this chart. The question is who's on the opposite end of the trade, because for every line that's going up here, there's an opposite line going down on the bottom. And these are speculators, which are mostly hedge fund managers. On the opposite end of this trade happens to be the commercial traders or smart money, which are really more of your producers, your crude oil producers, the big players in the market. So let's try to understand what's going on here. So we have speculators that are long and producers that are short. Now, the market believes that crude oil is going to go straight up. If you're looking at the price of crude oil, say back in 2008, you just saw the economic data was going down and crude oil was going up. And the market thinks that's going to happen again. They also believe that due to the new trade deal with China, which again, I have to remind everyone, it is an informal agreement. It is not an official trade agreement that is approved by Congress, that in order to adhere to the agreement, China has to significantly increase their purchase of crude oil and other crude products or manufacture or production products such as gasoline and distillates, things of those nature that China would have to increase their purchase of. So how do we interpret this hedging? Why are the commercials short? How do you interpret this? Well, you have to look at it this way. First of all, hedge fund managers believe there's going to be a big rise in oil prices, so they're speculating on it. So for about $2,500, you can buy 100,000 contracts in the futures market and buy yourself a lot of upside potential. So the question then is, why are the commercial producers short? Well, let's pretend we're an oil company. Is my risk that prices go, and I always like to think about extremes. Whenever I'm breaking something down, I like to just go to just really extreme numbers. So let's say, am I worried as an oil producer if crude oil prices went to $200 a barrel? No. In fact, I would probably love that. And why would I like that? Because what we know based on the data and what we're seeing in the oil industry, and this is not to be, what I'm going to tell you is not true for every company. It's certainly not true for the majors, but it seems like a lot of smaller companies are not profitable under 60. So we're starting to see some bankruptcies under smaller companies. So we know larger companies are going to be more profitable or profitable with 60, but 60 seems to be a level that's a problem. So if I'm an oil producer of some size, what is my risk? My risk isn't that oil prices go up. My risk is oil prices go down further, and due to the massive amount of debt load in the oil patch, so to speak, all the companies, there's just a massive amount of debt. My risk is that I go out of business if oil prices fall. So what am I going to want to do? I'm going to want to hedge that by being short the market. Does that make sense? That's why you see this big short position. It's not just because the oil companies think oil prices are going lower. They might think that. But their risk is oil prices go lower, they lose money, so they need a hedge to offset that. Fortunately, there's a lot of people out there that really believe oil is going to go higher. And so that's why they end up hedging. Now, what's interesting is when you look at the speculators versus the commercial hedgers, the dumb money versus the smart money is usually right. Now, why is that? So let's say major oil companies taking a short position to hedge production, which is smart. A speculator comes in and says, I'll take the other end of the trade because I think oil is going up. Who is likely to hold their position longer? Well, sure, the oil company is, because they're hedging production. A speculator just comes and goes. So when oil prices stop going up and they start to go down, because everyone's taken the position on both ends of the extreme, why is the smart money or the commercial hedgers always end up right in the end? Because they're holding their positions longer and they're holding them for a purpose. So when oil stops going up, the speculators will start to get out of their positions, and that will bring prices down and become a self-fulfilling prophecy for the producers who are short. Now, I want to show you something that hit the news last week was Oxy taking a huge short position, a huge hedge out in the market. Now, I am not affiliated with Oxy. I'm not suggesting that you buy, sell, or speculate on Oxy stock. I just want to show you a really good recent example of hedging. So what happened is Oxy took over a rival, Anadarko Petroleum, for $38 billion. And they took on a lot of additional leverage, so they needed some hedges to strengthen their cash flow in a low oil environment. That's why you hedge. So let's go down and see what they did. Here we go. So they said the firm, Oxy, could sell oil at a minimum of $55 a barrel this year, even if crude falls below that price to a limit of $45 a barrel. But the company's selling price was capped at $74.09 and lose out on any revenue earned from oil prices rising above that mark. Now, what's interesting about this is on Twitter and other places, all you could hear about was how stupid Oxy is. Really? That's what speculators, man, they're going to get, lose all this money. They're going to, and the cost of the hedge, that's going to really damage Oxy when oil goes up. Now, do you honestly think a company like Occidental Petroleum would take out a large hedge if they thought oil prices were going to go up? Now, let's really think about it. Let's say that all the oil producers, Oxy, Chevron, Exxon, and all the Shell, all the big ones, because if you don't think the executives talk, they do. If Oxy really thought that oil was going to head $100, $200 a barrel, they wouldn't need to hedge. It doesn't make any sense. But what do the big producers know that most other people don't? They know what the production is, and they know what the oversupply is, and they know what's in inventories. And Oxy's taking this position because they see downside risk to their business model, which makes perfect sense. And I think that's pretty much it for the article. So I wanted to show you that. So now the question is, what's going on with demand? Well, we know demand going into the end of last year was very weak because we saw not as much. We saw fairly decent crude builds, but toward the end of the year we saw the crude builds starting to draw. But we saw a lot of product builds in gasoline and distillates. And what does that mean? Is demand is going down. And the market, as I mentioned, is really focused on China because they've seen $55 billion as earmarked toward energy-related purchases. And so the market's thinking, man, as soon as China shows up and here's our cash, boom, prices are going to go straight up. Again, as I mentioned, it is an informal agreement. It doesn't say when China has to start purchasing. And if you get into the details, you'll find out it is based on market prices. They do have some leeway. The other factor is they already have other supply chains they've went and made deals with while this trade war was going on for the last 2 years. If you think they're going to cancel those deals overnight for this, they're not going to. So the odds are not favorable that China is going to be able to meet all of the demand. And now unless their economy starts to boom, but it doesn't appear that's happening either. But that's what the market's focused on. They think that this is some ironclad contract that China's got to come over and buy. So keep that in mind. And so these required exports out of the U.S. are supposed to bring up demand, hence why you see hedge funds taking long speculative positions. Perhaps the oil producers know something else, and that's probably why they're short the market. So looking forward over the next couple of months, other than Easter, there's no major holidays. Now in the past, we have seen draws in the early parts of the years, but it doesn't necessarily mean we always will. We've also seen draws during holiday times, and we didn't. So the question is, will demand come back? Well, we can go and look at demand at the Department of Energy's website. And you can go to the EIA.gov, and under the data, there is the weekly stocks data. And let's take a look at the crude stock. So you can click on the checkbox and hit graph, and my mouse is acting weird, but you can see going back all the way to 1990 that crude stocks reached an all-time high back in 2016 and are slowly headed higher. And they're very high historically. They are at the second highest level they have been. So you can see in 2010, the peak after the last recession, put oil stocks here, and look how high they are. So outside of 2016, oil stocks are high. And this does not count underground storage and say salt domes, does not count what's sitting on tanker ships outside ports. It counts what the government can track, is allowed to track. And inventories are high. So would you expect oil prices to rise or fall when inventory levels are high? Well, you would expect oil prices to fall when inventory goes up. From a production standpoint, my contacts tell me that refinery productions have been dialed down. Now, they're the lowest possible level, no. And if you run a refinery, you don't turn it off. I mean, unless you're doing heavy maintenance, you do not turn it off because it costs a lot of money and takes a lot of time, not only to turn them off, but to turn them back on. But we do know for a fact that refineries are running relatively low production numbers. So we're not seeing just an oversupply of production coming onto the market. So we're seeing low production. So let's go back and look at and see how gasoline stocks look. So we'll clear that checkbox off and we'll click there and we'll hit graph. And you can see gasoline stocks are almost near their all-time high. Now, some of this you can see some early year where stocks fall. And believe me, the market is hoping that all of a sudden gasoline inventories start to drop. But again, so far, there's no indication of that. We saw starting in October a big run up, and again, no slowdown during the holidays, even though I've already looked, production levels have dropped. It's not like the refiners are overproducing by any stretch of the imagination. So we know that for a fact. So let's clear that off and let's go look at distillates. And what are distillates? Think of this as diesel fuel, jet fuel, things of that nature. And look at distillate stocks. Now, this is really interesting because if you go back here, I mean, obviously it's noisy. If we could put a moving average on this, which I suppose I could download, we can do, but not directly from the EIA. But you can see that there was this big move higher back in, or right before the dot-com bubble. Here is right after the Great Recession. Here is a recession we should have had in 2016, and now we're starting to see distillate stocks starting to rise. They're not at their all-time high, but they're moving higher. Again, this does not present demand in the data. So from a data perspective, we don't see demand. Now, what about from executives? So we do know that corporate executives at the major oil companies have been selling stocks. You go, oh, well, you have inside information. No, I don't. Sorry, I wish I did. That would be really cool. But what I can tell you is executives are required by law to publicly state when they're buying or selling. And they have been selling for the last several years, if not longer. So we do know corporate executives are selling. And if oil prices were headed higher, which means oil stocks would also head higher, and you were a corporate executive sitting in the big boss's office with all the information and access to all the other executives in the industry, why would you be selling your stock if you thought oil prices and oil stock prices were going higher? Obviously, they don't. So let's take a look at some charts, and we'll come back and kind of, I also want you to be thinking in mind that debt levels, as I mentioned, I tried to dig up some data, but debt companies with oil companies is ridiculously high. And it's only going to get worse over a next 5-year period. So keep that in mind. And also keep in mind the companies, what we're seeing, need $60 a barrel. And we're at 58 as of we closed out Friday. And it's been hovering just a little over 59 in the futures market today. And I think it was dipping into the high 58 last time I looked. So this is a 10-year weekly chart of crude oil. And does this look like a bottoming pattern? Not really. What we see is crude oil continues to hit resistance for sellers anywhere roughly above $63 a barrel. That's where sellers come in and are happy to take that price. And that just could be a producer saying, hey, you all want to buy oil? I've got plenty of it. And if you're willing to pay me 63, I'll take it. So that's, or more. So that we're seeing that. And the major support area, if we zoom out on this chart, is here in the 50s. But if we start getting below 55, we already know that the Permian becomes unprofitable. And so that suggests that most likely with product builds, the crude oil prices are headed lower. And that would be normal during a period of a global economic slowdown and a period where the dollar is expected to rise due to the largest engineered dollar shortage in the history of the US dollar being the world's reserve currency. Let's look at symbol XOP, wherever it is. Here it is. And this is oil and gas producing stocks. So these aren't the big majors. We'll go look at a couple of them. But you can see that those stocks came down. Bottom here in the roughly $23 price range, went up in what looks like a topping pattern, came down below, and are now running into resistance right at the same level. There were buyers back here in 2016. And what does that tell us? The people who bought back in here, and you can see based on the volume in the Kai lines, there's quite a few of them. Those people really didn't make the money they thought they were going to make. And what happens? All of a sudden, when prices get right into the place where they bought, you see a spike in volume. So you see them selling here, and they're selling right back at the level they bought. They're not, really making any money on this, but they're trying to get out of their positions because they too think oil prices are headed lower. And let's take a look at a couple oil company stocks. We'll take a look at Chevron, and we'll see, again, Chevron stock, which we should see when we look at Exxon. We're not going to look at every oil company, but you see Chevron stock went down, and then it went up in a rising channel. And let me show you, this is obviously not going to be drawn to any exact format, but you can just see, whoops, my mouse is, every once in a while, it has this issue where it thinks a left click wants to be a right click, and it'll go away at some point, but it's highly annoying. And then we enter this triangle pattern where you can see this is a triangle. And when we look back over the last 10 years, we do not see a bottoming pattern. What we see is what looks like a topping pattern with some first resistance around 100 or support around 113, 111. And once this starts to fall out, the expectation from a charting perspective, we would think that Chevron stock is headed lower. ExxonMobil is probably the poster child for the world's largest topping pattern in the history of the markets because it hasn't broken yet, but it's sitting in a 12-year topping pattern. You can see it's got resistance at, or support at 65. Resistance is the bottom, resistance at the top, or support is at the bottom. But you can see that there have been buyers consistently at 65, but you can also tell when this thing breaks 65, you're going to have the largest topping pattern in the history of the markets break. And ExxonMobil is widely owned in lots and lots of places. It's considered a low volatility, low risk stock, and it is headed lower. So this is not a charting pattern of that's bullish at all, not even close. So let's kind of wrap this up. As we look at the global economy, is it expanding or shrinking? Well, the data continues to say it's shrinking. How about the U.S. economy? Well, it's better than a lot of the other countries for sure, but we're certainly not growing at levels we've seen in past cycles. So we have very, very weak growth. How does Boeing shutting down the 737 MAX production affect this? I mean, think about the whole supply chain. How much crude oil and gasoline and distillate products go into making one airplane? Probably a lot. And not only that, but you think about all the jobs and the smaller businesses that are created along the production line to supply Boeing and all the other manufacturers who put pieces together for the plane. When all of that production goes away, what's going to happen to demand? It's going to go down. And then you can look at transportation stocks like FedEx, which is, tanked compared to the market. And you hear every couple of weeks now a trucking company go out of business. If these companies are going out of business, what does that tell you from a transportation demand? And it's getting weaker. And obviously they are huge users of petroleum products. So my outlook over the next couple months is pretty bearish for crude oil. How low do I think it can go? I would not be surprised if it gets cut in half. It wouldn't surprise me at all. Maybe it would not. Like I said, I think potential in the 20s. Now, what happens from there? Well, what you'll see is the producers will then go from a net short to a net long. Why is that? Well, they won't want to miss out on the run up, that's for sure. But I think that's what's going to happen is we're going to see a big drop due to weak demand. And when oil finally gets to low enough where demand returns, then you'll see a rebound in price. But at least my short-term outlook, I'm not too bullish on it at all. I think we've got a big decline, and then from that point, we'll see a big rally. So I hope you enjoyed this, and if you did, maybe we will do an oil or an energy sector outlook update some months down the road to see if I'm wrong or if I'm right. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.